guys, this is Whitney, Program Ambassador for Mindset to Money, and I am back with another one. Now, have you guys heard of this infinite banking concept or creating your own private family bank? Well, if you have, you may also know that in general, what people are referring to is using whole life insurance to do so. Like most people, I used to think that being your own bank meant pre-funding specialized whole life insurance policies with like $50,000 to $100,000 or more, and then borrowing against those policies to buy assets or buy businesses. Well, in another one of my Mindset to Money masterclasses with Ross Brunson, we all found out that the insurance policies are just one small piece of the puzzle for how you keep your private family bank funded, and that there's actually a 4-entity structure that Ross recommends to create your private family bank in order to maximize tax savings and investment potential. But the masterclass with Justin Donald that I'm recapping today is all about funding your private family bank and the specific type of handcrafted custom life insurance policies that Justin Donald uses today. And he's gonna show us exactly what he did and how he did it. Now, it's called non-direct recognition whole life insurance. You can't just get these policies off the shelf, and most insurance agencies have never even heard of them. They are highly specialized policies, custom created specific to your situation by highly specialized insurance agents. It's very important that you choose the right whole life insurance policy from the right agents at the right company, or it could set you up for failure. Thankfully, Mindset to Money had Justin Donald on for an amazing masterclass on how he funded his multiple 8-figure private family reserve using non-direct recognition whole life insurance as the anchor for every single deal. Now, in the masterclass, he explains in detail which whole life insurance policies he uses, as well as the best whole life insurance companies to work with for non-direct recognition insurance, because there are benefits to working with specific insurance companies and drawbacks to working with others. He talked about how to create your own private family reserve and detailed numbers for the first investment he ever purchased using whole life insurance funding strategy that he will use again and again over the years to ultimately fund the liquidity in his multiple 8-figure private family bank. It's amazing, and in this snippet, I want to give you guys a sneak peek so you'll know specifically how Justin Donald thinks about which non-direct recognition whole life insurance policies he chooses and which ones he wants you guys to avoid and why. Check it out.
Really simply put, there are two classes of life insurance companies. You've got your class that is a direct recognition, and then a class that is a non-direct recognition. And basically what that means is some life insurance companies are going to directly recognize when you borrow against the cash value of your policy. So you're making premium payments into your policy. A percentage of that you have access to if you choose to. Most people don't ever take access to that money. And so the life insurance company just invests it and they make a return, and that's how they're able to pay you. They make a greater return than what it costs for to pay you the dividends. And, they're basically paying you whatever's left over after all the expenses, after all the fees, after everything. They pay you this dividend, which is their performance on the money that you gave them. So a direct recognition company says, hey, we want your money. We want to invest it. So if you're going to borrow against it, which you have the first right to be able to do, since it's your money, and it's a mutually held company, we're going to penalize you. And we're only going to pay you a percentage or a lesser amount of the dividend, since you're not giving us the opportunity to invest those dollars. A non-direct recognition company says, hey, we don't care whether you borrow it or you keep it in here, and we're not going to recognize that you have borrowed it. You're going to make the same dividend no matter what. So if you borrow it and invest it into something else, like I'll give you an example of here in a little bit, then we're still going to pay you the same dividend as if you left it in here and never borrowed against it. So that really is the difference between direct recognition and non-direct recognition. So for me, I'm a huge proponent of non-direct recognition because I borrow money from my policy a lot. Like I treat my policy as a bank, and I want to be able to put it into play, and I want to be able to get a higher return than the cost of borrowing those dollars. And if I'm getting the same dividend no matter what, then that makes it easier for me to have an arbitrage where I profit above and beyond my cost of borrowing that capital. Okay, I want to pause right here.
Okay, so do you now understand the difference? To see the rest and specifically what investment Justin used to fund his multiple 8-figure private family bank, you can get access to it by clicking the link below and following the instructions on the page. Thanks for watching, guys, and have a great day.